Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to be doing our looking at Twitter, seeing what's on social media, what people are sharing. I'm going to interject my financial opinions. It's going to be wealth building, financial topics, or commodity topics that I'll be talking about. So let's dive in here, take a look and see what's going on. Again, it's at finding_finance, and we've got finding-value.com if you want to join our community. We do have a discount called discount in the coupon code if you want a discount on the monthly and a bigger discount on the yearly membership if you'd like to join. Again, tankers, this was back in 2022. Nick is saying tankers are the biggest beneficiary of changing trade patterns due to Russian sanctions, period. A look into why tanker rates are surging this week and why this is just the beginning. I wanted to share that. We do have a lot of interesting setups over in tanker. And with the conflict over in Israel, this could have an impact on tankers and the rates and the price of oil. This is one spot we should be looking at for potential investments. Game of Trade says existing home sales have plummeted, reaching contraction levels only seen once since 1970. Now, I kind of look at this as a positive. If home sales are this weak, I mean, we could get a bounce here and come back down. It's possible, much like 1980, come up, then the bounce back, and then the move back up. But with rates where they're at, I can expect sales to be pretty weak. And, I mean, just thinking about it, we still have very low inventory levels. So sales can be weak, and if inventory levels are low, we're still going to be all right, I think, in terms of home prices. But yes, sales have definitely plummeted. This is copper producers warn of lack of mines to meet demand for metal. Guys, look out in front of us in the estimated sector. So we ran a little bit of deficit here. We come into a little bit of a surplus coming mid-2025, and then it just blows out. Now here's the thing. We need prices to be much higher today to meet this deficit that blows out in the future. If we can even meet that, I don't know. So big copper shortfall out there, starting to open up from 2027. Kobayashi says the gap returns between tech stocks and U.S. Treasuries. They've widened significantly since June. As bond prices continue to plummet, but equities hold higher, this gap is getting larger. This seems to be the elephant in the room. We will soon see a drop in equities to close this. And I agree with that. I think we could see a drop in equities. This is the Nasdaq 100, and this is the divergence we see with the 10-year U.S. Treasury return index. The reason there's this difference is because when yields go up, well, the reason that they're supposed to be more correlated, the difference here is yields have gone up and Nasdaq has not come down yet. Nasdaq has been very resilient in the face of runaway yields to the upside. So the risk in the Nasdaq is quite high given where yields are priced at. So a lot of people are speculating that the Nasdaq has to fall if yields remain elevated. And that's where a lot of speculation is going, that we're going to see a fall in the Nasdaq. Even Mohammed El-Iran and CNBC are waking up to the extreme seriousness of the situation in terms of war in Israel. How long before complacent markets smell the coffee? So basically what he's saying is this market, the U.S. outlook, even more difficult. He says if this expands and brings in other parties, the outlook is for even weaker global economy and more inflationary pressure. The markets are going to find it harder to deal with that. More inflationary pressure, and that is basically how we're positioned, is for the inflationary pressure. And some of that pressure could be felt in the bond market, rising interest rates, all of that stuff is tied together. if we get brought into a war, guys, we're going to print a lot of money if we get brought into this war. And there is a likelihood, there is a chance that we get brought into this. So in many respects, the weekend's events are the inverse. I don't even know how to say that. A kinetic meta conflict with high potential for second and third order effects that cannot be extinguished 48 hours later with an Aramco press release. This is serious, and oil shorts will cover the risk. We could go up dramatically in the price of oil. Usually when there's war, gold goes up, the price of oil goes up, and there's a lot of money printing and potential inflation from war in the world. Again, we'll see how this impacts the markets. We can watch it together, and I'll give my opinions as we go and other people's opinions on it. 50% of young adults are living with their parents, an all-time high from Morgan Stanley. All I see here are potential home buyers. This occurred, you can see, back in the 1930s all the way to about early 40s. These were all home buyers, guys. All the way from 40 to 60, it was one big home buying spree. I think that's coming. We've got a home buying spree coming at some point. And I understand people are going to say, well, what if the people pass away? Yes, there's going to be some of that going on. But the millennials are a larger demographic, a larger cohort, and they're going to come into home buying years right now. So this is fuel to the fire for a lot of home buyers. And I understand the affordability right now is pretty bad. But what else are you going to do with your money? I mean, you can buy a car, yeah, but I mean, what else after that? You're going to buy a house. That's kind of the next step. And I think that's what is going to occur over these next 5-10 years. Let's assume we can make a 4x. He's talking about uranium. The next 2-3 years in our uranium sector with spot price exceeding $150. What other asymmetrical sectors could be next? Is the timing realistic? I want to go into this thread here. It says, when and if we get to spot 150, we will see a lot more than a 4x on the miners, in my humble opinion. Lots of ratios to prove that. I am in the camp of Uselink here. I think we are going much higher than 150, and I think that the uranium miners are going to return much higher than a 4x. I don't know about 2 to 3 years, but it'll be more than 4x. Forget 4x, put 40% as a goal, which is to see November 21. Look around. So a lot of people don't think that uranium can go up much further than where we are today, than a 4x. Like that's not that much higher. Guys, the ratio of URA in relationship to the physical pricing is like 2020. We're going to have to go up like 20x to hit the top that we did before. I don't think there's a chance in heck that uranium's going to stop at 150. I just don't believe it. Too much inflation and too little supply. It's the combination of those two things. Too much money in the system going to chase too little product or supply of uranium. It says, first of all, 4x return from now in 2 to 3 years is not realistic in this guy's opinion. The other sectors with huge potential in a few years are nat gas, copper, and probably precious metals. If I were to take a guess of other ones with great potential, nat gas and Baltic Dry Index are my two favorite with precious metals. But I also think that uranium is going to blow 4x out of the water whenever that goes. Now, is it going to be within the next 2 to 3 years? That's my guess. I think it's going to happen within that. Some of these things went up like 20x in a year or two. It's just when is it going to start? Don't know. I just want to make comments there, and a lot of people are still in the disbelief phase. That's the phase that I was talking about what we're in disbelief. They are, this right here, by looking at this, first of all, 4x return from now in 2 to 3 years is not realistic. That's disbelief. They do not believe that this move is going to come with any sort of rewards. And there's a lot of people talking in the disbelief phase. We're coming out of disbelief, guys, and we'll go into hope soon. So far, the reaction in the markets to the tragic events in Israel and what they imply, especially considering Iran's role, is far too muted. Oil should be up a lot more than $4 and gold a lot more than 15. Treasuries and stock market futures should be getting hit much harder. I agree with Peter. We've got problems in our debt market, and I have a feeling if we get drawn into war, we're just going to print, 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 print. And gold should go up much more than $15. And oil, which is the most inflation sensitive asset, should be going up more than $4. Insane here. He's talking about the valuation of the Nasdaq versus treasuries. This ratio stands at 70% higher than its level during the tech bubble's peak. This chart puts into perspective how despite ongoing issues with treasuries, the more relevant question now is whether overall equities can remain as overvalued as they are in today's interest rate environment. This is just another way to show how overvalued the Nasdaq is in relationship to where interest rates are. This was the bubble in 99, 2000, and here we are today. This is going to rapidly go down at some point. We are in a massive financial asset bubble, and that's going to rotate towards our boy hard asset. That's where we're at. It's going to rotate to oil and precious metals and all those other fun areas that we are looking at. He says, is America getting poorer? Have our ruling clowns finally killed the golden goose? Half of young Americans are now living at home. Cars on the road have never been older. Houses are shrinking. The American diet is going third world. Even life expectancy is falling for almost a decade, breaking the 200-year trend. Expect more as Washington doubles down on crushing the American dream. There's some really good truth to what he's saying there. She's a 10, but she put half her portfolio into 30-year treasuries yielding 3.6% in May, thinking a recession was coming. What are you going to do there, guys? I don't think it matters because I've got my portfolio and it will hopefully make up for whatever mistakes she's making with her portfolio. And, I could understand that viewpoint that some people had that they were scared, but I don't know. I wouldn't touch treasuries. I would say she could be better if it was a 10 and she put half her portfolio into gold, thinking that a recession was coming. Then that's an 11 there. 11 there, boys. Just in, total U.S. debt jumped by $500 billion in just 18 days after hitting $33 trillion, according to Zero Hedge. Be exact, total U.S. debt is now $33.5 trillion. This means the U.S. has added $28.5 billion in debt per day for 18 consecutive days. That's $1.2 billion per hour and puts the U.S. on track to add another $1 trillion in debt in just 1.5 months. Under the debt ceiling bill, the U.S. debt limit is effectively uncapped until 2025. How high can this go? I don't know. Very interesting. If we get into war, it's going to go much higher than that. We got Patrick Karam here. Says, I'm hearing some have 18% targets for 10-year yields. That would be an epic generational event greater than 1981, where rates fell short of 16%. First, we got a 100-year resistance line at 5.4%. 1970s bull era for gold silver started above that 5.414. So look at that. We've got that long resistance line going across, and we're going to be entering, trying to break that resistance line at some point here in the near future. There he's got it on the right-hand side. So we could easily break through that and go into what was similar to the 1970s, 60s, 70s, with interest rates going above that 5% level on, this is the 10-year yields. So we could see a vast outperformance of gold during that time frame, which is a high possibility, I think. I talked about different assets classes here, and This one's about natural gas being so undervalued against other assets and the opportunities in it. So natural gas versus uranium, it's peaking up. Nat gas versus crude oil looks like it's ready to outperform. Nat gas versus Dow Jones, super cheap. Same with nat gas versus platinum, still super, super cheap. I think natural gas poses a very good opportunity. I think TTF gas will probably break to the upside before winter, and we'll see where this all goes. But I think nat gas, when priced against other assets, super cheap. I said energy in general is going to do crazy things, guys. This is the support structure of all life and all wealth for humanity on planet Earth. This is Ethereum versus uranium. This is from Scott. And he says, I think Finding Value will like this one. And what this is he overlaid Ethereum's chart over the uranium chart. We're right in this general section right here before the big move up, the straight kind of buying pressure move. And someone made the comment underneath. They said, what does Ethereum have to do with uranium? And what I said is, well, let me read it because I responded with a pretty good response, I think. Let me see if I can find that response here. I talked about David Mirren and a McKay wave coming up. There's going to be huge inflationary surge in the future, which will drive all of this. It has less to do with supply-demand balances and more to do with the credit creation and the imbalance between credit, money, and how fast supply can react to it. Well, anyway, I'll go in and describe. The reason he's showing Ethereum, what this is Ethereum basically scribed out this fractal. And the fractal is just humans trading with each other. It's the psychology behind humans. I think that he is completely right. We've compared this pattern before, Ethereum, Bitcoin, and all these other ones to uranium and CCJ and all these other patterns. I think we're going to see a big move to the upside in uranium that's going to absolutely put it's going to blow the hair back on a lot of people if you've got hair. All right, it's going to surprise a lot of individuals on how high oil, nat gas, and uranium actually go, and the inflationary pressures in the system that are building. And when credit gets created or when money gets created, it puts energy into a shortage, and that's going to be the driver of it. It's not going to be supply demand. It's going to be credit demand. The credit side is what's going to I think spike energy. So he's just showing that the herd is lining this thing up for a big move to the upside. The psychological behaviors before this big move are all in alignment for a big move to occur. So that's what I'm gonna end at, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. And guys, that's all I've got. Everything still looks bullish for everything that I look at. The war is just going to increase the inflation in the system if we decide to go to war, and things could get worse. Things could escalate. Inflation could get worse. And as far as I'm concerned, the portfolio is positioned for that and ready for it. All right, guys, that's all I've got for today. We'll catch you later. This is Finding Value.